So, what is the current state and future outlook of the real estate market? From various interest rates and market sentiment to the many supply dynamics, it is imperative that investors have long-term strategies. Today, I am joined by PricewaterhouseCoopers tax partner and national real estate leader, Fred Cassano, who's going to shed some light on the ongoing economic uncertainties and geopolitical tensions that investors like us are facing today. Well, it is apparent there are challenges such as rising interest rates affecting mortgage costs. There are also opportunities for investors in different asset classes like student housing and data centers. Additionally, Fred touches on PwC insights into government initiatives that are aimed at increasing housing supply to address affordability issues, and adds some very great perspective. There are many takeaways in this particular conversation. We cover what's happening in Alberta, Toronto, British Columbia. Listen in, enjoy. Fred Cassano, PwC, welcome to the Rain Channel. Thanks for joining me.
Hi, Patrick. Happy to be here. Looking forward to the discussion.
Oh, we had a lot of things to talk about, a lot of ground to cover. So, Fred, before we get started, share with the audience what your role is with PricewaterhouseCoopers. Let's talk about that, and then let's kind of lift the hood and get into some conversations about what's going on in real estate, the economy, investments. We got so much ground to cover.
Sounds good. So I'm a tax partner and also the national leader for real estate, which includes providing value on many different fronts, all related to real estate, bringing our teams together on the assurance and tax side, which is what you traditionally think of PwC, but we also provide real estate advisory services on the valuation side, on the restructuring, data analytics, highest and best use studies using data analytics to help guide decisions, and working closely with many government organizations, crafting strategy and the like from a real estate perspective. So all things real estate. My role also is unique in that we spend a lot of time with Urban Land Institute. Here we partner with them. It's going to be now our 47th publication going into 2026, where we look for insights on emerging trends in real estate. So we interview last year 200 C-suite across the country to get their insights from what's happening in real estate. So that gives me unique insights that we then share with our global territories in the US and UK and Asia. So we actually combine forces on providing global insights on real estate as well.
Beautiful. Well, we got a lot of ground to cover, a lot of conversation to be had. In my own world where I'm doing a lot of research, that I'm looking at what's happening economically, how it applies to real estate, what real estate investors may want to consider, primarily the do-it-yourselfers of the world that grow portfolios, create financial futures investing in real estate. And I often come across parts of your research that, coming from a reliable source and using it to put the pieces of the puzzle together is helpful. Now, we've got some events coming up, and part of within our marketing strategy, if you will, we're talking about SOS, given what's going on economically. And SOS is an acronym for strategies, opportunities, and solutions, as we in some regions are in this economic storm. Others, the economic storm seems to be on the horizon, but there's some thunder and lightning we're seeing. So how do you see it when we look at and talk about what's going on economically? I'm not a big fan of painting, the whole country with one brush, because of course economies are regional, provincial. How do you unpack all that? How do you look at the economic world that we're in right now?
I always viewed it from an opportunistic perspective, or as my friend George Karras likes to say, crisituity. There's opportunities in every crisis, and I think that's very true for real estate. You can't paint a brush on broad statement sentiment on real estate. You actually have to delve into asset by asset class comparisons and opportunities. So high level, I would say there's a few things that are giving us optimism. One, transaction volumes globally potentially have bottomed out when you compare transaction volumes in the last few years, and perhaps that's a sign of money sitting on the sideline, ready to come in. And in fact, our respondents have told us that capital seems to be ready to be deployed in various asset classes relative to last year being more undersupplied, both on the equity and debt side. And then we also look to spreads between bond rates and cap rates. They seem to be widening, so that's indicative of potentially more money moving into real estate rather than sitting in risk-free returns. And then overall interest rate movement, very helpful in the last year. Interest rates, certainly at the Bank of Canada, going from 5 to 2.75, and hopefully, I think there was an announcement yesterday. Potentially, the benchmark is going to hit 2.25 by the end of the year. So I think that's very helpful. So those are positive indicators to real estate. So we look at that in terms of forming strategy, so that you can then use that to decide where you want to be in the next 5 years. Because real estate is long term, right? You can't really try to get too nervous on today. It's very important for directionally, but what is the long term strategy? And I see sentiment improving in the factors that I just mentioned. Of course, you can't have a discussion these days without talking about tariffs, right? The trade war, geopolitical. Certainly, there's a tinge on whatever optimism based on where we land on negotiations. But I think overall sentiment should be good going into 2026.
Okay, so 2026. So I think there's a couple of highlights here, points that you make that are really, really important. Number one is market sentiment is driven by emotions today. As investors and strategically, we're not investing for today, we're investing for future. So ultimately, we look at what's going on in the market today and say, well, things are a little bit frightening. People are standing off onto the sidelines. And within that, there's some opportunity as we start to realize or think about, is this going to be the way it is in 3 years from now, in 5 years from now? And historically, that is not the case. Historically, the pendulum swings one extreme one way and then an extreme the other way, and we get caught in the emotion of it. Market sentiment changes. There's a lot of topics that I would like to cover with you and hear from your perspective, and you brought it up. When we look at bond yields, I mean, they've been, I don't know, have they ever been this volatile? Number one. Number two, when you look at bond rates and how they impact fixed rates, fixed mortgage rates, for example, how do you and how within the organization are you seeing the future of interest rates? Do you agree that they're probably, or are you kind of thinking, yeah, they're going to come down, but it might take a year?
I think it's a fantastic question because you'd think as the Bank of Canada reduces rates, that would also trickle to changes in mortgage rates. But that hasn't happened because your long-term bond yields really dictate what happens at the mortgage level. And we think it's because the U.S. Has not lowered their rate. I think they're still sitting at 4.75%. They're dealing with inflationary pressures, certainly before the tariff discussions. So I think what's happening in the U.S. has really implicated long-term yields and as a result mortgages. So I think a lot of the things that we used to use as indicators are more dynamic and subject to change. So I think people just need to maybe step back a bit and say, okay, the old rules of decision making need to be rethought, if you will, in the context of this complex, dynamic world that we're living in, and especially in the trade war that we're in right now, really instigated by the U.S. So it's hard to predict that your mortgage rates are going to go down based on Bank of Canada rates. So hopefully, when that settles down, maybe those will also come down. But I think, economists and a few mortgage specialists and a few other people in the industry have the view that we're never going to get to a 2% mortgage rate anymore. I think 3.5 to 4 seems to be the new norm, and that's how we're going to navigate decisions on buying real estate.
I have some single family rental properties that I've had for many years. So mortgages are bought right down. And so it's not a huge issue, but I have renewals coming up. And, when I talked to the bank just recently, the best rate they were going to give me was 4.45, I think. And, I was kind of pushing them and saying that, there's stuff out there that is maybe, 3.9, 3.95, but they weren't going to budge on that. Now I know that that's also because of they were rental properties, they weren't primary residence, which is also seems to be a differentiating factor in the rates that they get. But a high three, like a 3.95, seems to be available. I think that when we consider variable rates, if you're going to stick with a variable as opposed to locked in, those are decisions you have to make. But you also have to be really paying attention so that you have when you start to think about what those fixed rates are going to do, you may want to be on top of it and lock in sooner than later.
Absolutely.
It's a juggling act, isn't it?
Absolutely.
So when you think about affordability, and let's just kind of switch to affordability given interest rates, we're seeing, depending on the property type in the world of, we look at the Toronto, Vancouver condo market, lesser degree Calgary, is really, Toronto's melting down, Vancouver's a lighter version of melting down, and Calgary arguably is really showing some softening. But that seems to paint the whole market with the same brush, but it's really not the case. So when we look at affordability, the condo market is in fact coming down, but detached or semi-detached, not so much. How do you guys look at it? How do you, when you're evaluating an economy and affordability, do you break it down by property type, or how is it that you kind of do your analysis?
Absolutely. So let's take all residential property types. You mentioned condos, single family, low rise. I would throw in student housing, and then seniors. Those are all, call it, residential properties. And I wouldn't say that there's a melting down, because you have to value it or analyze it by asset class. Let's talk about condos first, right?
Toronto, let's be specific even. Look at the Toronto/GTA condo market.
Toronto condo market that has been driven based on the pre-sales
Speculation.
speculation or model that requires a certain amount of financing investors before you achieve financing. But those investors, were after market appreciations, and certainly I was part of that game as well. You buy at pre condo stage, and hopefully you gain on
Sign it.
gain on appreciation.
Yeah.
And it worked because you had low interest rates, and you had a rising economy based on immigration. But I think there's a few factors at play, right? The investors are now gone, right? Because no one's making money on capital appreciation. In fact, there's been studies announced or released, excuse me, that a lot of investors were actually cash flow negative and were hoping for
Sure.
capital appreciation. So that's no longer part of the picture, because resale prices for condos in the GTA are in the $1,000 mark, right? 1,000 a square foot. So no condo is going to launch at less than resale, right? Because there's a certain amount of profits that need to be made. In fact, I'm not sure if people know, but Patrick, did you know that 31, maybe it's even higher now, percent of the cost of a condo is actually government charges and levies?
Yeah,
Or
I did know that, and it's one of the many things about our government and the municipal governments that infuriate me. But yes, carry on. I'm
yes,
very aware.
so costs, taxes, and when you talk about costs, you have labor, you have your inputs, the zoning entitlements, your capital at risk for so many years, call it 7 to 10 years before you from concept to completion. That all goes into the modeling of a condo, and if you don't have enough profit, then you're never going to build. So certainly at a resale price of 1,000, it's certainly less. So it's just certainly difficult to launch a new project. But now we have also with investors, walking away from deposits, potentially unsold inventory. I think the current level is around 30,000 units unsold in the GTA, and it's estimated to grow as conditions potentially get worse. So what's that going to do to overall prices? Potentially, uh, it drive down the cost per square foot of condos, right? So
Hmm.
are we then going to see new condos being launched in the future? Uh,
No.
Potentially no, right? But if no one's building, right? We're actually seeing forecasts in 2028 and 2029. There's actually going to be no new product released or
Yeah.
completed, right? So if you believe in supply and demand, and the demand is going to continue to come from immigration, then potentially we can see higher per square footage in the future. And in the future, so what does that mean from a condo perspective? I think we need to just step back and say, okay, what happened during the last 10 years from how we built and what we sold? Because what's interesting about the unsold units, there's a lot of single family, sorry, not single family, single unit, one bedrooms available.
Mhm.
That's not really helping families. And we talk about the missing middle, the three bedrooms that are missing. So I think if we're going to rethink condos in the future, we have to rethink also the type of condo unit that's developed. People talk about the end user in mind, not the investor. So that's going to be part of business model reinvention, certainly from a condo perspective, and certainly how we finance condos. So I think it's a good time to pause on how we build and how we market and how the units are constructed for condos. So I think it's a moment in time. It's still going to be a very important facet of delivering units to our community and Canadians that want to live in the dense spaces, which have a lot of good factors for it. But we need to rethink condos. So
Well, I think,
that's
yeah,
just one aspect of residential.
yeah. So I think there's, condos, what they refer to in Toronto as dog crate condos. I think those are going to be a tough sell and a tough rent for the next few years, but ultimately they're not bringing anything new out of the ground. There is no new construction in Toronto in that condo market. Anything that's coming up is already been in the works for a while, and they will bring it to completion, but there's no new project starting, to your point, which will in the future could lead to a shortage. Having said all that, from an investor point of view, what we do know is what has slowed down is the building of detached, traditional family homes and or even duplex, triplex. There's a lot of multifamily being built because of the MLI Select program that's out there. Everybody's rushing into that multifamily space to build because the math works. The MLI Select program, 40, 50-year amortizations, all those things help the cash flow. When you're looking, from your view, and you're kind of guiding your clients who are interested in investing in real estate, I have a thought process that for many investors, the thing to do is look at a REIT. You don't have to apply for a mortgage. You can get in later. You don't have to go through the process of qualification. I mean, there's lots of benefits to it, but that's, looking at private REITs as an example, if they're well managed, et cetera. But in given the current real estate environment, are you still believing in that model in terms of putting capital to work? And I want to touch on a couple things around that, but how do you view it overall right now when you're giving guidance to your clients?
In terms of investing in REITs.
Yes. Well, REITs, well, real estate in general. I using REITs as an example, but because I still am very bullish on real estate for a lot of different reasons as a place to put capital, to place capital to get the return and to get that gain of appreciation. But what's your view of it?
Yeah, I think the as an investor, I would look at various asset classes that are actually performing well, like student housing. There's still under supply of student homes. If you compare Canada to the UK or other parts of the world, we are still behind on the level of student housing that's available, and we have old stock, right? So you have companies like Fistrovia or others that are really building at mass, and I think it's a very dynamic space because it's still fragmented. We don't have a national platform. I know Forum Investment is probably our first national Forum Asset Management. Recently completed an acquisition that will be the first national platform, but we still need more. So it's fragmented. The rents are mark to market. So every time a new student comes in, there's an ability to potentially increase the rent depending on market forces. With a caution, right? Is a highly operational business that you have to really, work the efficiencies, and it's very operational intensive of asset class. So I think student housing is attractive
Mm-hmm.
from an appreciation perspective. The other one that we always talk about is the alternative asset classes. So
Mm-hmm.
the intersection of infrastructure coming together with real estate. So it's not residential, but it's data centers or cold storage or
Mm-hmm.
self storage. It seems to be a very popular area for a few reasons. On the self storage, driven by e-commerce. E-commerce continues to expand globally, and we'll start seeing more product being available or coming to online for more industrial units focused on self storage. Data centers, everything storage right now is popular. So data storage certainly, whether it's e-commerce to Bitcoin to AI, Gen AI, that's fueling growth in data centers, which is a big part of industrial. Of course, the biggest issue there is power. So my point to you, Patrick, is yes, perhaps maybe on the condo side, it would you would move with caution, but there's certainly other elements of real estate that are trending, like
Mm-hmm.
student housing, like everything storage, data centers, and self storage that are attractive, and they're attractive because they also provide a steady stream of income,
Mm-hmm.
especially for these large facilities, fulfillment centers that have one big tenant. Then you can have a steady stream of income. Of course, you're going to say, well, that's not for the everyday investor, and that goes back to your question. How do you participate in some of these large industrial type assets? Well, you probably get them through the REITs, right? So there's
Mm-hmm.
certainly some REITs that are big on industrial assets, or alternative funds like a Nicola Wealth or others that have industrial products. So I would look to that in to those asset classes, but participating indirectly through the REITs.
So I want to run a scenario by you, and this is just my view of it. But I would like, and please, I'd like your expertise and even challenge it. And maybe you don't see it the way I see it, but let me kind of play this out, and maybe you have a view of this. So when I'm looking at, and we talk about what's going on, I look at global macro. We can't deny what's happening, with the U.S. and, I don't know, Israel, Iran, Russia, Ukraine, China. I mean, there's so many dynamics that are putting us on, the edge of, potentially a major world war, potentially. But the point of it is that within that global macro uncertainty, we're seeing things like, the what I call the canary in the coal mine, which is the canary in the gold mine. We're seeing gold prices go up, which is to me always is a good indicator of something bigger underneath the surface that impending. We see bond yields being the volatility that they are. But here's my point to all of this is that monetary policy for any number of years, we could go back to 2008, 2009 when it really changed. But then, of course, COVID drove that into a whole new stratosphere. But I'm seeing that Canada is again starting to ramp up liquidity. And so, whether we agree with that or disagree with it, aside from that, as investors, I'm looking at it going, we need to get our capital into hard assets. There's, I believe, no denying that fiat currency in general is losing value. It's decoupling. And when we start to see the more money going into the system, hard assets, as in real estate, as an example, are going to continue to appreciate. And as much as we think they're appreciating, it's also the argument is that our dollars are getting weaker. That's my view of it. And that's why I'm saying that investors need to get their capital to work. And a year from now, you're arguably your $100,000 or whatever your number is going to be probably at least 15% less buying power. And that may be debatable, but let's just use that as an example. What's your view of that philosophy? Am I on point, off point? Is there some corrections to put in that thesis? What's your thoughts, Fred?
Well, you mentioned gold as an example. Certainly, whenever there's a crisis, gold goes up. So it's a security blanket. I also think it's a good conductor for chips, right? So there's probably some value in that asset class too.
The actual application of it as a product.
Yeah. But certainly there is a sentiment that when things go straight, and there's people run to gold for security. I also think Canada is a safe bet for international money. Pre U.S. Trade, we had a lot of interest from the U.S., U.K., sovereign wealth, Korea, Germany looking into Canada. And Canada has a lot of good things going. When you compare, geopolitical issues worldwide, Canada really has its act together. Sure, we are divisive on a few issues, but we certainly have a strong system, and there's a lot of good ideas that are not really too radical on both sides that will come together and help solve a purpose around housing affordability. It was strong banking system, and not a lot of volatility. So with that comes a lot of investor appetite for Canada. So I think I agree with you. Your premise is, if you want to have a safe haven, and you want to tie it to physical assets, I would go one step further. Why not Canada? And I think there's a lot of good things going for it, especially going back to the data center view. Alberta is open for business from a data center perspective. I remember going to the Calgary Real Estate Forum. Invest Alberta was publicly talking about 20 potential investors interested. I think they've grown it to 90 focused on Alberta data centers alone. So that's going to attract a lot of international interest. I think DECA is a fund from Germany that's taking a position on purchasing some offices in Vancouver, right? Which is fantastic. An asset class that in the past, office was a bad term. Well, that's a physical asset that's being purchased by a foreign institution. So you're going to probably start seeing more of that. We had, Well Towers. This is all public information. Purchase Amica, which is a platform for senior homes across the country. So there's a lot of foreign interest coming into Canada. So I support your thesis that in times of crisis, you may want to link to physical assets, but I would go one step further and say maybe it's in Canada.
Well, yeah, and it's interesting that we're Canadians living in Canada, and it's always the case of we're in it, so it always looks we have a different view of it, and certainly given what went on politically with our federal government, and then the discourse that happened provincially. I mean, it really takes any confidence. It can really suck the wind out of the confidence sail, if you will. But now that we've got to a place where we've actually got a prime minister, we've got hopefully a government going back to work soon and making some decisions. We've got negotiations with the US and what's happening in the tariff world that will continue to cause some challenges. But this goes back to, I think, where we started, which is in amongst the chaos is always opportunities when we start to stay, or when we get focused and realize that if we're looking into the future, this kind of, we'll call it this economic storm, if you will, if we call it that, this too shall pass, as they say. Up to us as investors to put our capital to work. When we look at the housing market, Fred, and you and I talked about it, just touched on it, briefly off camera, was when we look at affordability and, the promise or commitment by our federal government to up supply. I think we would both agree that that's just not going to happen. Not in a traditional sense of how we might view it. I mean, who knows what they will build, but what's your kind of again, from your professional opinion within your organization, how are you viewing what that commitment was and how you see affordability into the future?
Well, when you say the commitment, you may be referring to the Liberal platform on Build Canada Homes, which is to stand up a new Crown Corporation focused on building at scale, right? So,
yes.
First of all, I think it's a good program. I like a few aspects of it for sure because it's dealing with partnering with private developers to build, right? Because the skepticism sometimes is government cannot build, right? But if it partners with the expertise of private developers, then it can happen. I also am excited to hear that the government is making their lands available for sale or for partnership to build affordable homes, right? So Canada Lands, Canada Post, National Defence, RCMP, all the lands that are available there potentially to partner with developers to build affordable homes is exciting, right? That's needed. I also am excited that the government's investing. I think it's $25 billion in loans to assist with prefab, assembly, modular construction. Because if we are going to build at scale, also assisted by this design catalog that the government wants to use to help expedite approvals, which I like as well. We're going to build at scale not only with the labor force that we have, but en masse with prefab and modular. So, am I excited? Yes. Is 500,000 homes per year achievable? I'm uncertain about that because even in the best years of building, we were hovering around 250,000 to 270,000. So to almost double that with a program, I'm a bit cautious about that, but I'm excited about what we're talking about. We're talking about building at scale, building differently, putting lands to work, partnering with privates, and providing tax incentives. We talked about multi family homes. There's a lot of incentives that the government has already introduced, whether it's increasing depreciation from 4 to 10%, to maybe carving out some of the non-deductible interest. To you mentioned the MLS Select program, and hopefully more to come. I think even the MURBs may be coming back. The multi-unit residential buildings that provide tax shield to investors, of course with some caution, but these are all good ideas that excite me about what government is doing. to help with the supply side of the equation.
So, there's because we our audience is as much as the general public is often investors. So when we think about if the government were to pull this off, which I think both of you and I can be pretty skeptical about 500,000, maybe they'll crank it up and let's assume they do. But if they do, what does that mean to investors? When you think about the, part of what drives appreciation, drives rents is the fact that supply is always a little thin or a lot thin, depending on what region you're in and what's going on. So if we kind of look at the premise that they're going to deliver on that, because right now affordability is creating a lot of renters. So in other words, first-time home buyers that can't get in the market, they are in fact renting. Now, as a rental housing provider, that's great because we have a growing demographic of renters. And so as an investor, good news. Having said that, on the other side, we debate and want affordability, which will then perhaps saturate the market of real estate. I don't know. Like I'm throwing it out there because I know that question is going to be living with somebody in the audience that's watching this going, hold it, if we got a lot of supply coming on, what does it mean to us as rental housing providers / investors in real estate? You got a thought on that, Fred?
It's a very interesting question. I think we need supply because if you don't have supply, it's just going to just run up your rental rates, and it's just not going to be achievable for most Canadians. So what does that do for the multiplier effect or the offshoot of not having people be able to afford homes, right? It's your workforce is not existent. Call it your first responders, your service workers. That's all not achievable, right? So I think it's very, very, very important that we have supply to make sure that market rent is kept low, right? From an investor perspective, when the construction market is on fire, that there's always a multiplier effect that leads to more jobs and more income to Canadians that can then invest. So if it's not directly investing in real estate, there's a lot of disposable income that allows you to invest in other things as well. So I think it's important to focus on bringing supply from the rental perspective to ensuring that individuals that we have a great workforce that can live in the city. Because if you don't, you have a hollowing out of the city.
Sure.
Right? Like you saw that happen during the pandemic, and even after the pandemic, restaurants were closed because they just couldn't find people. The hotels were struggling to get people come to work because they couldn't find people. Well, it's the same as the case if you can't afford to live in the city. It's the hollowing out of our cities, and that would be shameful.
Mm-hmm. I think as investors and as leaders and wanting to kind of unpack all of this, we don't always have the answers. What we have to, and how I look at it, is I'm going to look at the data. I'm going to try and connect as many dots as I can to create a thesis that I can take action on. So, we look into the future and we start connecting dots, and, a lot of it is quite pragmatic, but if it's data driven as opposed to emotion driven, I mean, it changes the conversation, right across the board. And so when I ask these questions, it's more about, I guess, fueling food for thought in a way of looking at the market, because right now there's so much emotion depending on where you're at. You look at a province like Alberta, for example, that is going through through a cycle. Calgary went through their boom cycle. Edmonton's coming out of a boom cycle. I think they're going to start going into a slump cycle of real estate. When you look at the real estate market within the organization, do you view it in cycles, or what's your perspective of how you break down a real estate market by city, by province? Is there a way of assessing or operating that you guys fall into, a system, if you will, of assessment in that regard?
It is viewed in cycles. I'm not sure about Edmonton potentially going into a down cycle. Certainly from our emerging trends report, Calgary's now listed as the top market to watch.
Mhm.
Edmonton's number five.
Mhm.
And there's a few reasons. One, the net migration into the province because it's more affordable from a ownership perspective.
For sure.
But they're about to embark on a massive energy cycle that could
Mhm.
last a long time. We're talking about again power to fuel data centers, right? It's your fossil, your alternatives, your nuclear. You're talking about pipelines like we've never heard in a while. So I think Alberta is set for massive expansion. So I would follow them for energy. I would follow them for net migration, huge data. Sorry, excuse me, a huge tech sector.
Mhm.
Whether it's a tech sector that you couldn't afford an office or to live in Toronto or Vancouver, and they moved to Alberta.
Mhm.
But also huge tech sector from mines and the engineers and all the tech that's embedded in energy.
Mhm.
And then a business friendly province, lowest tax rate, and
Yeah.
deregulated, so it's business friendly. So yes, we look at cycles, but we look at other fundamentals as well,
Mhm.
like those for Alberta.
I
Uh,
think Alberta, and just to interrupt, and so I'm clear, I'm hugely bullish on Alberta as a province. I see nothing but kind of positive stuff going forward, and of course all the things that can happen that happen. Whether it be federal government and emissions and all of the things that
correct.
are kind of percolating that could have an effect. But I'm also really, really I don't know. I'm excited about the fact that Alberta's economy is diversified so much more than it has been in the past. And of course, if oil and gas slow down, it will definitely have an impact, but not to the same degree that it has in the past. And there's a lot of, to your point, there's a lot of initiatives in even in clean energy, if you will. We're talking about data centers. Whether or not Kevin O'Leary raises the money to do the Bitcoin whatever it is outside of Grand Prairie, we'll see. But those are also initiatives that are very positive for the province. Cost of living is significantly lower than anywhere else, and incomes are higher. I mean, it's just got a lot going for it. So I'm totally
Yeah.
a big Alberta bull. That's for darn sure.
I would throw one more in that it's almost a distribution hub for
Mm,
Canada. And recently we saw the completion of a new state of the art facility for cold storage
mm,
in Alberta as well, with access to distribute some of its product down to the U.S. as well. So, I would throw or I would add, excuse me, industrial hub potentially for Canada in Alberta. Land's cheaper, and the ability to build at scale compared to other parts of the country.
There's something that you should not step over, which I think is really important, but also a consideration is that, you talked about Toronto. Well, we talk about Ontario and BC, but you talk about some of the municipalities, and, Vancouver and Toronto are poster childs for what it costs, what we pay for condos. 30+% is in zoning and permitting and taxes and all the things that go directly to government. Now, Alberta, on the other hand, has a way different policy. When in Calgary and Edmonton, we'll use them as the major cities, but it's far less expensive and way less prohibitive in terms of getting projects up and running and going. And we don't have a 30% headwind if you're a developer. You don't have that 30% headwind that you're paying out, and of course, and the 7 years, 3 years, 5 years of process to go through the bureaucracy to get things up and running. And so to that end, I mean, I think I'm very optimistic about affordability and continuing affordability in Alberta in general. But again, I want to come back to you, and what's your view of that? I'm happy to be wrong or right. I mean, I'm good either way. I just like your perspective, given what you do.
I think if we really cut our DCs or development charges in Toronto and Vancouver, that we can get back to building again, which is what we need. And I think the answer or the question is going to be, well, how do we replace that revenue, right?
Mhm.
Because certainly municipalities will look for that revenue. Well, I mean, we could look to other sources or other ideas, which is, one thing that we've been thinking about is municipal utility districts, where some of the infrastructure spend that developers have to spend in advance for sewers and roads and other infrastructure, maybe there's a district that's developed that issues bonds, and then over time, when the community is built, then that bond is repaid through your property tax base or special assessments over a period of time, so it's not so stringent, but it actually lowers the cost to the developers, and hopefully it lowers the cost to build, right? So I think my point is, let's get rid of the DCs, let's build in a big way, and but come up with some ideas that are not new ideas. Let's just borrow them from other parts of the world, to think differently on how we bring product. So to your point, about affordability, I think and bold action needs to be taken. And I think it's possible, so that we can start building again in a big way in our major cities, Toronto, Vancouver in particular. But I think Calgary, will still be a good destination. It's affordable and business friendly, so it'll continue to attract a lot of individuals.
So when you have clients that are coming and the people or what you're doing, and are you? I know that I don't want to use the word advice, but how are you advising clients to, I don't know, to look at different asset classes? Are you advising them to, make sure they're liquid in through these times? How are you advising them to kind of look at the potential or the feeling of an economic storm that we're either in or going into? I mean, there's so many different views of, we're in a recession, we're not in a recession, we're going into a recession. From your research and the team that you have looking at the world, how are you advising some clients?
That's a loaded question, right?
I know, but I had to put it on the table, Fred.
And the answer is gonna start with, it depends, right? So
Of
so
course.
it depends on what your starting point is, right? So if you've currently been allocating real estate amongst office and industrial and maybe other asset classes, is it a time to maybe pivot, right? Pivot your portfolio. Maybe you sell down one portfolio in favor of another, and then you take a longer term view. It's also dependent on what's your current leverage model, right? So if you've been really highly leveraged, maybe it's time to become more liquid. Maybe easier said than done, or vice versa. If you've had a strong balance sheet without a lot of leverage, maybe the time is to leverage and take advantage of some distressed assets, or other opportunities. So I think we look at a holistic view of what the real estate strategy is, based on what your starting point is. Help pivot portfolios. Look at what your capabilities are, and there's so many things at that level as well. Like, are you managing real estate or are you outsourcing it, and what's the right model? So I think we help in many different things. Certainly from a strategic perspective.
Mhm.
We also, you mentioned data. We also use data analytics to help drive informed decisions. We actually have a proprietary model, 3,000 data points to the postal code, all right, to help figure out what properties or sites that you can select. And then once you select it, or what can you build on it, mixed use, condo, apartments, retail component, all that stuff, and it spits out a pro forma as well. So I think using data to help inform real estate decisions, together with your strategy on what your starting point is and where you want to be in the next 5 to 10 years is very important. So it depends, Patrick, on various factors, and also your risk appetite, because depending on either the age of the individuals or the age of the company, maybe there's a wind down strategy versus a startup strategy that maybe want to take a few risks versus others that maybe want to take chips off the table. So it's all over the map, but certainly it's a holistic view of it starts with strategy, then execution, and then risk appetite.
Okay, so I'm going to go to a different question, and I don't know how you want to answer, like just whatever it might be for you. But as you're sitting around the boardroom table with your team, and or your teams, whatever it might be, how are you looking at what's going on economically from your point of view? Are we in a recession? Are we out of a recession? Are we heading into one? What's like when the recession word is getting kicked around a lot, and there seems to be some debate whether or not we're in one based on GDP, and then they give a GDP number and then they reconfigure it down the road. What's your take on it? Are we in a recession or not? Let's just ask the question, Fred.
Oh, can you hear me?
Yeah,
Sorry.
I can.
To connect Jabra Speak 710, go to the Bluetooth menu on your mobile device
Patrick?
and select it.
Yes.
So I think there's a technical term to the recession. So I think it's 3 consecutive quarters of declines in, I believe, GDP, and then if you're officially into the recession, hopefully you got that right. But again, we're a real estate advisor. It's a long-term game, and I think there's a few things that we look at. Spreads, certainly, as we discussed before. We also look at first movers, right? And usually, whether it's family office or private equity, that's first movers on certain deals. And I think we distinguish between distressed assets versus, call it, normal sales, as an indicator of, okay, are we going to see more capital being deployed? And then thirdly, is how easy is it to raise funds, right? And right now, I would say it's very challenging to raise funds. Usually, the cycle. Actually, there's probably no definitive term for or timing for raising, but I would say
No device connected.
It's actually very, very difficult to raise funds unless you're conviction led investors, which is going back to my first point, is driven by private equity and family offices. So right now, I would say I'm cautiously optimistic because there are first movers on deals, right? And that to me is very positive. However, there's a lot of caution, especially if you're in the condo residential world, and don't have a strong balance sheet, that potentially could be some more distress. However, beyond that, there's other asset classes that give me confidence that there's opportunities. So I know you talked about recession. I view it as long-term nature, which is real estate. What are the indicators that are driving investment activity? So spreads, transaction volumes, first volume, family office, and private equity at play.
Got it. So, first, I think you refer to it as first movers. It's the old case of follow the money. And that's always still a pretty good strategy to pay attention to, or at least follow the money is a good way to kind of look at the world as an investor, because the big money always kind of leads the way. Is that's a pretty good philosophy? Yes.
Yeah, and the first or follow the money, Patrick, is in the alternative asset classes. All of the ones that we talked about, everything storage, multifamily is still a attractive asset class,
Yeah.
and cautious around uh, condos and office. Office is improving, by the way,
Yeah.
in a few respects. But I would say the alternative asset classes are leading the way.
Beautiful. Okay, so as we wind down, you've been very generous with your time. I appreciate it. Some great insights, by the way, Fred. I really, really like this conversation. Hope you're enjoying it too. But as we wind down, is there anything that we didn't cover that you want to make sure that our listeners hear from your perspective?
I think we did cover a lot. Certainly the labor story is not amplified enough.
Mm,
I
yeah.
think that we have an aging workforce. We now don't have enough people coming into the trades. We have heard stories of labor productivity issues. And if you think about all the asks of labor, right, whether it's the expanding energy sector or more infrastructure projects or building at scale, how are we going to address our labor shortage?
Mm,
Certainly, targeted programs around immigration and training and upskilling. Oh, that's a must, right? And I think I want to go back to our previous point that we also have to really embrace technology to help build homes differently, en masse, with assembly, prefab, and modular. And I know that comes with a risk, right? Because
mm,
if you spend time and money putting together these large facilities, and all of a sudden, production stops, then you're sitting with a big capex and no work. So that is a risk.
mhm.
However, I think we're sitting at a really big opportunity to maybe address some of the labor shortfalls with tech and modular. So Patrick, I think over the course of this year, even next year, I think we're going to really start hearing more on the labor side, right?
Mm.
Strategic ways that we can upskill, tailor, individuals to be in the right place at the right time with the right skill. So the whole conversation around labor will certainly amplify as we start building en masse.
Well, and only because it popped into my head, and I know that like me, you're bullish on Alberta, and you start to see. But I'm also, and this is my read on it, and I'd like to maybe you have a read on it closer. Is that we start to see unemployment in Alberta kind of head north of 7%, but a lot of that I believe is just strictly the volume of people moving into the province, and the absorption rate just isn't there to pick up that slack yet. And to your point is, when we look at the requirements of labor, how do you see that unemployment in Alberta kind of unfolding? Do you think it is about absorption? Do you think that as people move into the province and we'll start to get other things fired up? How do you view that?
I think people will. I think with immigration and net migration, there'll probably be a short-term period where there's a mismatch of people looking for jobs and not lining them up with the right jobs.
Mm,
So there'll be a point where it will adjust. So I think that it's a short-term measure
yeah.
right now, or short-term imbalance between matching the right skill set with the right individuals. That's and I don't have data to support that, Patrick. I
Yeah.
just high level demand for services with not a lot of supply should lead to a match, right? But
Yeah.
that's without data to support.
I get it. But I'm on that page too. So, Fred, I want to just say thanks for your time and your insights. Appreciated. And I hope to have you back on the show again. And we'll do another update at some point soon.
It was a blast, Patrick. So I really appreciate the invitation, and looking forward to continuing this conversation.
Fantastic. Thanks, man.